Sheng Siong Group is Singapore's third largest supermarket chain behind Dairy Farm and NTUC, with around 70 to 75 stores on the island and a small presence in China, and recently opened its sixth store in Kunming, where stores are still loss-making, have yet to break even. Founded in 1985 and listed in 2011, it's known for fresh produce at value prices, strong cash generation, and a no-debt balance sheet. Over the past 4 years, Sheng Siong's share price has risen from roughly SGD 1.60 in 2021 through SGD 1.80 in 2022, SGD 1.90 in 2023, to above SGD 2.10 today in 2025, a total lift of over 30%. This table shows Sheng Siong's financial performance from FY 2021 to FY 2024. Revenue rose steadily from $1.37 billion in 2021 to $1.429 billion in 2024. Net profit grew slowly from 133 million Singapore dollars to 137.5 million Singapore dollars, showing that profit growth has been modest. Gross profit rose to 435.5 million Singapore dollars, with improved margins, but take note, administrative and distribution costs have increased significantly, driven by staff bonuses and higher overheads. In short, revenue growth of 4.5% is paired with modest profit growth of 2.3%, while expenses are rising faster, particularly staff costs, limiting margin expansion compared with regional peer DFI Retail Group, which operates over 6,000 outlets across Asia, including cold storage and giant. Sheng Siong is much smaller and focused entirely on Singapore and China. On valuation, Sheng Siong's PE today, 19.8 times, is slightly above its historical average of 18-20 times. PE ratio is highlighted red. Sheng Siong is relatively expensive. PEG ratio in yellow is moderate. Concern. Net profit margin is highlighted green. Let's now compare Sheng Siong's valuation metrics to its peers. It trades at a PE ratio of around 19.8 times, higher than DFI Retail and the industry average of 16 to 17 times. Its PEG ratio is 2.8, which is considered high. This means the share price is expensive relative to its growth rate. Dividend yield is about 3.5%, which is respectable and comparable to DFI's 3.8%. However, net margin is much stronger. Sheng Siong maintains a net profit margin of nearly 10%, while DFI Retail has only around 2.5%. So while it's priced at a premium, it also runs a leaner, more profitable operation. Shows operational strength. Analysts are mixed. Some see upside to 2 Singapore dollars and 30 cents, almost equal to 8% gain, while others forecast downside to as low as 1 Singapore dollar and 89 cents, almost equal to 11%. So is Sheng Siong a buy? If you prioritize steady dividend income and low leverage, it remains solid. But for growth investors, the premium valuation, limited expansion potential, and rising costs may make it a hold or conditional buy only if margin improvement is proven. Follow and subscribe for more in-depth Singapore stock analysis.